Welcome to The Explainer. Today, we're going to break down a really powerful forecasting tool called time series analysis. It's all about how looking at the past can, believe it or not, help us predict the future.
All right, so let's jump right in. We're going to start with a challenge that, honestly, every single business faces. Doesn't matter if you're a tiny startup or a huge corporation. I mean, think about it. How can you predict with any real confidence what your sales are going to be next month, or what demand will look like next quarter? The future feels so uncertain, right? It's a huge challenge.
Well, it turns out one of the best ways to look forward is actually to look back. And we do that using a technique called time series analysis. You can think of it as finding the hidden signal, the real pattern, inside all the noisy data from the past.
Okay, so here's where it gets really interesting. This whole method boils down all that complicated data into just two key parts. Two things that we can actually understand and work with. So I want you to picture your data like a choppy sea. It's all over the place, right? The trend is like the main tide. It's the general direction everything is heading, whether that's up or down over the long run. And then you have the seasonal variation. Those are the repeating waves on top of the tide, the predictable ups and downs you see every day, every week, or maybe every year.
Theory is great, but let's make this real. We're going to roll up our sleeves and play the role of the analyst here. Let's dig into some sales data and actually find the trend to see how this all works in the real world.
Okay, so here's our raw data. A full year of sales numbers, and just look at it. The numbers are bouncing all over the place from one month to the next. Just glancing at this, it's pretty much impossible to tell what the real story is, right?
So, to cut through all that choppiness and find that underlying trend, we're going to use a nifty little technique called moving averages. It's a really simple four-step process that basically smooths out all those crazy peaks and valleys, and we just do it over and over again. All right, check this out. Here's how it works. Step 1, we take the first 3 months, so that's January, February, and March, and we just add up their sales. That gives us a total of $456,000. Now here's the key part. You take that total and you stick it right next to the middle month of that group, which in this case is February. Okay, we're almost there. Now, to get our very first moving average, which is our trend value, we just divide that total by 3.
And boom, that gives us $152,000. And just like that, we have our first trend value. See how that number gives us a much cleaner picture of where sales are actually heading? All that random monthly noise is gone.
And this is what's so cool about it. When you do this for the whole year, a really clear pattern emerges. In our example here, you can see that each new moving average is exactly $2,000 higher than the one before it. So now we know the underlying trend is a steady growth.
Okay, so we found the tide. Now, let's move on to the next piece of the puzzle. Now that we've isolated that smooth trend, we can figure out the seasonal variation. Remember those repeating waves we talked about? This part is actually super straightforward. The seasonal variation is just the difference between what actually happened in a month and what the trend said should have happened. So if we look at February, the actual sales were $7,000 below the trend we just calculated. And when we do this for all the months, look at that. A super clear 3-month cycle just pops out. The first month is a little below trend, the second month is way above, and the third month is back down again. And this little dance just repeats itself over and over.
Now, just a quick side note here, there are a couple of ways to measure this variation. We just used what's called the additive model, where you're just adding or subtracting a fixed dollar amount. But there's also a multiplicative model that uses percentages. That one can be a lot more accurate, especially if your overall trend is growing really fast.
Okay, so this is the moment we've been building up to. This is the whole point. We can take that steady, predictable trend and combine it with that repeating, predictable, seasonal pattern to actually forecast the future.
So let's put our money where our mouth is. Let's try to forecast sales for June of next year. That's a full 7 months past our last piece of data.
It's a 3-step process, really. We'll start with the last trend value we know. Then we'll project that trend forward for 7 months. And finally, we'll add in the seasonal adjustment that we know happens in June.
Okay, let's run the numbers. We start with our last known trend, which was $170,000. We know the trend is growing by $2,000 a month, so over 7 months, that's another $14,000. Then we add in June's special seasonal kick, that positive $32,000. You put it all together, and you get a final forecast of $216,000. So there you have it. It's a fantastic tool, right? It gives you a real forecast based on actual data. But, and this is a big but, it's really important we talk about its limitations. It's not a crystal ball.
The whole thing is built on one giant assumption, that the future will look pretty much like the past. It assumes that $2,000 a month growth is just going to continue forever. It doesn't know about things like a product's life cycle, when it starts to decline. And it has absolutely no way of predicting some huge external shock, like a recession, a new technology, or a new competitor swooping in.
So, in the end, time series analysis gives us this amazing, data-driven path to follow. But it's also a powerful reminder that you always have to ask that one crucial question. What could happen that would knock us completely off this path? What's out there that could make the future totally different from the past?